Welcome to the Opening Bell Report.
There's this old joke in the finance world that technical analysis is basically just astrology for men.
Yeah, I mean, it definitely gets that reputation, doesn't it?
Right. You're sitting there squinting at these squiggly lines on a screen. You're trying to find shapes. A cup and handle here.
A head and shoulders there, yeah.
Exactly. And you're just hoping it somehow predicts the future. It feels a bit like reading tea leaves sometimes.
It does get a bad rap, but then you have moments like the one we are in right now.
Yeah, where the chart stops being abstract art and starts looking a lot more like a battlefield map.
That is the perfect way to frame it.
Because right now, if you are looking at Tesla ticker TSLA,
yeah,
that is exactly what you're seeing. You can actually see where the armies are dug in.
We aren't just watching random price fluctuations today. We are looking at a massive technical crossroads.
Which is why we're doing this deep dive. The analysis report we have in front of us paints a picture of a stock that is just coiling.
Testing the patience of the bulls who have been holding through all this volatility.
But it's also setting up a very specific scenario for technical traders. The report calls this current phase the defiant ascent, which honestly is a pretty dramatic title for a stock chart analysis.
It is dramatic, but when you look at the pressure the stock has been under recently, it really fits.
So let's set the scene for everyone listening. Currently, as we dive into this steez, Tesla is hovering. It's consolidating right around that $411.82 mark.
Right in that pocket.
But the mission of this deep dive isn't to just tell you the current price. You can check that on your phone in 2 seconds. We want to decode why the chart looks this way.
The underlying mechanics.
Exactly. We're going to talk about the fortress underneath the stock, the magnet pulling it up, and why the experts think $490 is the next logical step on this run.
And to get there, we really have to talk about physics, or at least market physics.
Market physics. I like that. So let's start at the bottom. The foundation. The report spends a lot of time talking about the 200-day simple moving average.
The ultimate line in the sand.
Right, but for the uninitiated, that sounds like a lot of math homework. Why is everyone staring at this specific moving average? Why is the 200-day so special?
Well, it's less about the math and more about the psychology. The 200-day SMA is just calculated by taking the closing price for the last 200 days, adding them up, and dividing by 200.
So it smooths out all the noise of the daily volatility.
Exactly. But for large institutional investors, we're talking pension funds, sovereign wealth funds, the big banks, this is a major psychological barrier.
So this is the line that separates a good stock from a bad stock in their eyes.
Largely, yes. It represents the long-term macroeconomic trend. If a stock is trading above its 200-day SMA, the long-term trend is considered healthy. It's up.
And if it falls below?
If it falls below and stays below, the trend has reversed. It becomes damaged goods. It tells the institutional algorithms that the momentum has officially shifted to the downside.
Okay, so it's a litmus test. Where exactly is this line for Tesla right now?
The report identifies this fortress, as they call it, in the critical support range between $384 and $387.
$384 to $387. That's the floor. And we actually saw Tesla get uncomfortably close to that recently, didn't we?
We did. And this is where your battlefield analogy really works. The stock recently tested the waters below $400.
It dipped its toe in.
Right.
Yeah.
For a moment, it looked like it might slip and crash right through that floor.
Which would have been catastrophic for the technical narrative, right? Everyone would have run for the exits.
Precisely. If it closes decisively below that 200-day average, the algorithms just trigger massive sell orders. The narrative shifts from buy the dip to abandon ship.
And that didn't happen.
No, it didn't. Instead, we saw aggressive buying pressure. As soon as it touched those lower levels, it was like it hit a trampoline.
It propelled instantly back up into the low $410.
Because the big players defended the level.
Yeah.
By stepping in and buying heavily at $385, they signaled to the broader market that the long-term uptrend is still totally intact.
They're basically telling the market, we are not ready to give up this ground.
It's a massive show of strength. And in technical analysis, a successful defense of a support level is often more bullish than just a stock going up in a straight line.
Because it proves there is real demand underneath. It shows resilience.
Exactly. It confirms the floor is solid.
You can't jump high if you're standing on quicksand. You need concrete.
That's a great way to put it. The defense of $385 provides the concrete footing needed for the next leg up. So now that the floor is confirmed, the eyes in the market and the algorithms turn upward.
Okay, so the floor is concrete. Let's look up then. Let's talk about the destination. The report points to a very specific target for this bounce, and that is $490.
$490 is the number.
Now, I have to play devil's advocate here for a second. Why $490? Why not even $500? Why not $450? Is this just chart astrology again, or is there a hard reason for this specific number?
It is definitely not random. In this kind of high-level analysis, very few numbers are arbitrary. The $490 target is deeply rooted in two things: historical supply zones and options market mechanics.
Let's start with the history side of it. What exactly is a supply zone?
Well, first you have to look at the 52-week highs. Tesla's recent high watermark is sitting right at $498.83.
So basically $500.
Right. $490 represents the primary supply zone right before you retest those absolute highs. A supply zone is just a price range where selling interest has historically been really strong.
With the final boss battle before you get to the high score.
Exactly. People who bought at the top last time might be looking to just get out at break even. Traders are taking profits. It's a turbulent area where a lot of shares change hands.
Okay, that makes total sense. The natural friction point where people want to cash out. But the report also goes into a deep dive on something called gamma. And honestly, whenever I hear gamma, I kind of zone out a little bit. I feel like we're entering the matrix.
It can be complex, but it is essentially the hidden engine behind short-term stock movements. If you ignore gamma in today's market, you are missing half the story.
Well, we don't want you to miss half the story. Break it down for us. What is the report telling us about gamma and this run to $490?
The report points out that there is a massive concentration of call walls and positive net GEX, that stands for gamma exposure, in the $495 to $500 area.
Okay, let's define these terms so we don't lose anyone. Call walls. What are we actually looking at?
Think of a call wall as a massive accumulation of bets that the stock will go up to a certain price. In this case, thousands of traders, both retail and institutional, have bought call options expecting Tesla to hit $500.
So a ton of people are betting on $500.
Correct. Now, on the other side of those bets are the market makers, the dealers. These are the big banks or financial firms selling you that option.
The house, the casino.
Right, and the house never wants to gamble. That is the golden rule of Wall Street. They want to make money on the fees and the spread. They do not want to care if Tesla goes up or down.
But when they sell a call option, they're technically short the stock, right?
Exactly. If the stock goes up, they lose money on that option they sold you because they have to pay you out.
So how do they protect themselves? How does the casino ensure they don't actually lose?
They hedge. They buy the actual underlying stock. And here's the mechanism. This is the gamma part. As the price of Tesla stock grinds higher, closer to that $490 level, the math dictates that the dealers have to buy more of the actual stock to stay hedged.
Wait, so as the price goes up, they're forced to buy more stock?
Yes. They are short gamma above this zone.
And when they buy more stock to hedge,
the price goes up,
which forces them to buy even more stock.
You got it. It creates a massive feedback loop.
It's literally a magnet.
It is effectively a magnetic pull. The report describes it as dealer hedging accelerating the move upwards. It becomes a self-fulfilling prophecy fueled by the actual mechanics of the market, not just sentiment.
That is wild.
The closer you get to that $400 to $500 zone, the stronger that magnetic pull becomes because the dealers are just scrambling to cover their exposure.
It's like the math takes the steering wheel from the driver.
It really does. And in modern markets, these options flows often matter way more than the news on any given day. It explains why a stock might surge for seemingly no reason. It's just the dealers balancing their books.
So we have the fortress floor at $385 preventing a drop. We have his gamma magnet at $490 pulling us up. But charts and math don't exist in a vacuum, right? You can't just have a spreadsheet drive a stock forever.
You took the words right out of my mouth. The report explicitly states technical setups rarely work in a vacuum. You can have the most beautiful chart in the world, perfectly primed for a breakout with all the gamma in the universe. But if the news cycle is terrible,
if the company announces a massive recall or misses earnings,
that chart will completely fail.
You need a narrative. You need fuel for the engine.
Exactly. The technicals provide the path, but the fundamentals provide the push. And this report identifies 3 specific fundamental catalysts that are providing that fuel right now.
Let's run through them because they're fascinating. Catalyst number 1. This one sounds like it is straight out of a sci-fi movie. We're talking about the cybercab and wireless charging.
This is a really significant development that I think flew under the radar for the average person, but definitely not for the smart money. Tesla recently secured an FCC waiver to utilize UWB, that's ultra-wideband technology, for wireless EV charging.
So we are talking about parking your car or your robotaxi, and it just charges.
Yeah.
No plugs, no heavy cables.
That is the vision. And getting the FCC waiver is a tangible regulatory step toward making that a reality. It means the government is saying, okay, you can use this specific frequency for power transfer.
But why does this matter for the stock price today? It sounds like a really cool feature, but is it a game changer for the valuation?
It matters heavily because of the robotaxi narrative. Think about it logistically. If you are going to have a massive fleet of autonomous taxis driving themselves around 24/7 to make money, who is going to plug them in?
You can't have a human standing at every supercharger waiting for a cybercab to pull up. That completely defeats the purpose of autonomy.
Exactly. It ruins the unit economics. You need them to charge themselves. Wireless charging solves a massive logistical hurdle for the entire robotaxi network. It makes the business model viable.
So for investors, this FCC waiver isn't just bureaucratic paperwork.
No, it's proof that Tesla is building the physical infrastructure for its AI future right now. It strongly reinforces the AI and autonomy premium that is built into the stock price.
That makes a lot of sense. It validates the dream.
Yeah.
Which brings us to catalyst number 2, the data moat. We always hear about data being the new oil. What is the milestone the report highlights here?
The report notes that Tesla's supervised full self-driving, or FSD, has now crossed over 8.2 billion driven miles.
8.2 billion. That is a number I can't even really wrap my head around. How does that compare to the rest of the competition out there?
It is enormous. It absolutely dwarfs everyone else. And the key here is the concept of a data moat. In AI development, whoever has the most real-world data generally wins. The report directly compares this massive lead to competitors like Waymo and Uber.
Waymo's doing great things, though. I see them driving around San Francisco all the time.
They are doing great things, but their fleet is limited. They are in very specific geofenced areas. Tesla is collecting data from millions of customer cars all over the world, in snow, in rain, on dirt roads, and unpredictable construction zones.
So every single time a Tesla driver engages FSD on their morning commute, they're essentially training the brain of the system.
Exactly. They're constantly widening the gap against the competition. And that reassures investors that Tesla's lead in autonomy isn't shrinking, it is likely expanding.
Which justifies the high valuation multiple.
Right. It's the snowball effect. The more cars they have on the road, the better the data. The better the software gets, the more cars they sell.
Okay, so we have the futuristic tech with the wireless charging waiver. We have the massive data advantage with the 8.2 billion miles. Now let's talk about the third catalyst. This one feels a bit more adversarial. The short squeeze.
Ah, yes. The eternal battle between the bulls and the bears.
The report mentions short seller exhaustion. That sounds like the bears are just getting tired of fighting. Is that what is actually happening on the charts?
In a way, yes. Think about the bear case recently. Prominent bears have been very aggressively targeting Tesla, specifically betting against its AI and data center goals. They've been saying the valuation is totally disconnected from reality and that the AI promise is just hype.
But the stock hasn't collapsed to prove them right.
Right. It is stubbornly holding that $385 fortress we talked about. Now, if you are a short seller, you are paying interest to borrow that stock.
Yeah.
You are literally bleeding money every single day. The stock doesn't go down.
It gets very expensive to be wrong.
Extremely expensive. And here is the trigger the report points to. The upcoming Q1 earnings, which are expected in late April.
That is coming up soon. Why is that specific event the trigger for a squeeze?
Because expectations right now are mixed. If there is any upside surprise in those earnings, maybe better margins on the core auto business, maybe concrete news on the Cybercab timeline, or maybe energy storage numbers blowing out estimates, it could trigger a massive squeeze.
Walk us through the mechanics of a squeeze again. I feel like that term gets thrown around on the internet a lot without people knowing how it works.
Sure. Short sellers have borrowed stock and sold it, hoping to buy it back cheaper later. That is how they profit. But if the price suddenly jumps up on good earnings news, they are instantly underwater. To stop the bleeding and cut their losses, they are forced to buy the stock back to close their position.
And their panic buying adds to the regular buying from everyone else who liked the earnings report.
Exactly. It drives the price up even faster, which forces more shorts at higher levels to panic and buy.
It's a cascade.
It is a violent cascade that the report suggests could propel the stock right through its resistance levels and shoot it straight to that $490 target. It is the fuel igniting.
So we have the floor at $385, the magnet at $490. And the fundamental fuel to get us there. But I want to be realistic for you listening. The report calls this a roadmap, but roadmaps usually have bumps in the road. What are the risks here? Is it just a straight shot to $490 from 411s?
Definitely not a straight shot, and the report is very, very clear on the conditions. The entire technical bias, this whole bullish outlook we've been discussing, is conditional.
What is the primary condition?
The bias remains tilted to the upside only as long as TSLA holds that $385 base on a daily closing basis.
That is the safety net. If it closes below $385.
Then the thesis is completely broken. The fortress has fallen, the dealers readjust their hedges to the downside, and we are in a different, much more bearish scenario. You have to respect the stop loss.
Okay, so that is the downside risk. What about the hurdles on the way up? We're at $411 now. $490 is still a ways away.
The immediate hurdle is the turbulence overhead. The report points to a cluster of moving averages just above the current price. Specifically, the 50-day simple moving average, which is currently hovering right near $440.
So $440 is the first real ceiling we have to break through.
Exactly. The stock needs to punch through that $440 level with some volume. It might struggle there for a bit. It is like breaking through a thick cloud layer. But the report suggests that once that $440 ceiling shatters, the path of least resistance becomes clear.
Path of least resistance. I always loved that phrase in trading. It essentially means there isn't much standing in the way anymore.
Right. It's open air. There isn't much historical selling volume trapped between $440 and $490. So once you clear that turbulence at $440, those gamma mechanics we talked about, that magnetic pull from the dealer's hedging, can really take over and smoothly pull the price toward the supply zone at $490.
So let's synthesize all of this for you. We have covered a lot of ground today. We've got the technical support levels, the complex options, mathers, the fundamental AI story. If you had to sum up the trade-off here, what does it look like?
It really comes down to a clearly defined risk and reward scenario. The risk is a drop below $385. That is your strict invalidation point. If it breaks, that you step back. The reward, however, is a potential run to $490. And that run isn't just based on blind hope. It is fueled by the mechanical positioning of the options market and tangible news regarding FSD miles and wireless charging infrastructure.
It really is the defiant ascent. I can't get that title out of my head now. It implies that the stock is climbing despite all the doubts, despite the intense volatility.
It fits the data perfectly. Tesla has defended the fortress at $385. It has a fueled-up engine with the autonomy narrative, and it has a very clear destination marked on the GPS at $490.
It is a good reminder, too. We look at these charts all day, and we just see squiggly lines on a screen. But those lines represent the psychology of millions of people.
Millions of people and billions of dollars in capital.
Exactly. Every dip, every bounce, every wall is a collection of human decisions. Fear, greed, conviction, and in this case, the ruthless math of algorithms, too.
That is the most important takeaway for you today. When we talk about support or resistance, we aren't talking about physical barriers. We're talking about collective psychology. At $385, the collective psychology said, "This is too cheap, we are buying." At $490, the question is whether the collective psychology will say, "This is too expensive, we are selling," or if the sheer mechanics of the market will force it even higher.
And that brings us to the final thought for this deep dive. We've talked about the bears betting against the AI hype. We've talked about the bulls betting on the future. But the report lays out something much deeper if you read between the lines.
It definitely does.
If the options market is already heavily positioned for a run to $490, if those call walls are built and the dealers are legally obligated to hedge, and if the AI narrative is heating up with real tangible things like wireless charging waivers,
it raises a fascinating question for anyone watching this stock.
It sure does. Here is the provocative thought I want to leave you with to ponder on your own. If you are betting against Tesla right now, are you betting against the stock? Or are you actually betting against the math of the market itself?
And historically speaking, in this market, the math usually wins.
Something to chew on.
Don't forget to like, share, and subscribe for more.